My name is Godfrey Luaka. I'm the training coordinator at CIC Insurance. Basically, unit trust is a form of investment that insurance companies have adopted. And you realize that there are different types of unit trust, whereby we have the money market fund, which is very, very common. Then we have the treasury bills and the treasury bonds. And the main difference between the treasury bills and the treasury bonds is that the treasury bills is when the treasury bills and bonds is when the government is borrowing money from the public. And the money market fund, this is an investment program that registered fund managers pull funds from different people, then they invest in various investment vehicles, including the treasury bills and bonds. So basically, that is the money market fund that is really taking shape in the Kenyan economy today. The right one to choose will vary from an individual to another based on their needs at any particular moment. Of course, considering the features, because number one, the reason why the money market is really taking shape in the country, it's because number one, it has got what we call capital preservity. So it means your capital is guaranteed at any given time. Number two, when you're venturing into a money market fund, there is what we call liquidity. In most cases, it is easy for you to access your funds. The other thing is that it is also easy for you to track and see your investments at any given time. Then number three is in a money market fund, this is whereby your money is continuously working for you even when you're asleep, because there is an interest that is earned every day. And every day when this interest is earned, at the end of the month, we take this, we consolidate the interest, and then we put it back onto your capital. So every month there is a new capital, thereby maximizing on the compound interest feature. How early can someone start? So as long as you are making an ends meet, so as long as you are earning an income, it is important that you start early. Why? Because the earlier you start, the better for you, because you'll have a longer time to do so, and you'll be able to maximize on the compound interest effect. Of course, low risk is mostly in low risk. You realize that the interest rates are not as high. But then again, remember, in a low risk investment, it means that your returns are low and your capital is very much preserved. In cases where you will realize that there are high risks, it means the possibility of even eating into your capital is very high. So it is important that when you are venturing into some of these investments, you also measure your risk appetite, because the higher the risk, yes, the higher the return, but then again, you are likely to lose on your capital. In unit trust, the most important thing is being consistent, because remember, as I've mentioned earlier on, that this money is earning you a return on a daily basis. So as much as you will be getting a new capital every month, anytime you inject back, anytime you get in an extra income that you're injecting into your capital, also doubles up on the interest. So you'll be maximizing much more on the compound interest effect. So consistency is key. The reinvestment is automatic, because at the end of every month, we consolidate what the fund has earned during those days. Then we put it back directly into your account. So it is not unless you access it. If you don't access it, automatically it is reinvested back into your fund. So as I mentioned earlier on, you need to be consistent and also patient so that you can maximize on the compound interest effect. There are people that are very, very much hesitant, and of course, people really there are those people that we call them the fence watchers, people who sit at the fence to see things happen. I would just encourage someone, start small. In any form of investment or savings, start small and then grow as you grow. Grow as you grow, and your funds will also be growing. So start small, wherever you are, start it. The best thing to do is to start.
My name is Duken Kamidigo. I'm a financial advisor at Kuza Asset Management Limited. Low risk investment normally offers capital preservation and also high liquidity. So that means that you can always be able to access your funds whenever you need to. And secondly, you'll enjoy the capital preservation, meaning that your capital is guaranteed. However, when we are looking at high-risk investment options, normally they are long-term in nature. The fund manager could be investing in asset classes like stocks, which are quite volatile and high risk to some extent. And it's also an investment option that it's not for everyone. So the investor for the high-risk investment are very familiar with the volatility associated with stocks, for example. Yeah. What we advise investors to do is to diversify their portfolio. Don't put all your eggs in one basket, so to speak. So you can have the short-term or the low-risk investment options, you put some funds there, and you can also diversify and spread it even to the high-risk investment options, where you are now able to exploit any opportunities as and when they come over a given period of time. Yeah, like the unit trust funds, for example, the money market fund or the fixed income fund. By default, you are investing unless the investor withdraws the money. But if they were to leave it there, it would reinvest in perpetuity. Be consistent, consider doing periodic top-ups, and be patient, because it's not a get-rich-quick scheme. But within a period, a reasonable period of time, you'll be able to adapt some of your investments. Yes.